Let's look into the discrete insurance. When we are saying it is a discrete insurance, it means that the payment of the benefit will only be made at the end of the year of death. We are going to assume that the death benefit is $1. Let's look at the level benefit whole life insurance case. Since the benefit payment is $1, we are going to have the present value of the random variable. Let's assume it is z equals to v to the power of kx plus 1. As I mentioned just now, discrete case, you are going to have, for the discrete case, you are going to have the payment being made at the end of the year of death. For example, if policyholder dies in between year 0 and year 1, the payment will only be made at the end of year 1. Die somewhere here, payment will only be made here, and so on. If the policyholder dies in between time k and k plus 1, the payment will only be made at time k plus 1. So, we are going to have the expected value of z equals to summations from k equals to 0 up until infinity v to the power of k plus 1 k given qx. Let's look at these illustrations for better understanding. Let's say this is the entrance of the insurance, year 1, year 2, year 3, and it will continue forever. The coverage will be until the persons die. So, if a policyholder dies in between year 0 and year 1, he will receive $1 at the end of year 1. Dies in between 1 or 2, you will receive $1 here. Dies in between 2 and 3, $1 here. To get the present value, if you receive at the end of year 1, you only need to discount 1 year. Receive at the end of year 2, discount 2 years. Receive at the end of year 3, it will need to be discounted for 3 years. Probability of receiving this $1, the policyholder has to die here in between time 0 and time 1. So, probability will be qx. To receive the $1 over here, he has to die in between here and surviving this year. To survive this year is px. Die here would be qx plus 1, which is also equals to 1 given qx. Here it's also equals to 2 given qx. It will continue forever. Okay, so the expected value of z equals to this plus this plus this. You're going to have v qx plus v square 1 given qx plus vq 2 given qx plus and so on, which is also equals to summations from k equals to 0 up until infinity v to the power of k plus 1 k given qx. Its actuarial notation is ax. Second moment would be summations from k equals to 0 up until infinity v to the power of 2k plus 1 k given qx with actuarial notation of 2ax. Variance of z is the second moment minusing the first moment square. Now let's look at the second case for the level benefit term insurance. For the level benefit term insurance, similar to the above, if you draw the timeline, you will have something like this. 0. Let's say the term is n years. So you are going to have 1 year, 2 years, year 3. This would be the entrance. So if die somewhere here, $1 will be paid here. Die somewhere here, $1 will be paid here. Dies here, $1 will be paid here. Die somewhere here, $1 will be paid here. Okay. Discount factor would be V square, V cubed, depending on the years, and Vn. Probability of receiving this, that means the policyholder has to die here, which is Qx. Here, 1 given Qx, 2 given Qx, and forever until here it will be n minus 1 given Qx. Expected value of z equals to summations from k equals to 0 to the power of summation from k equals to 0 up until n minus 1, v to the power of k plus 1, k given Qx. Its actuarial notation is AX and with 1. Remember, 1 is for term insurance. Variance of z would be 2AXN minusing AX and 1 square. To find 2AX and 1 is similar to the above, so I'm not going to repeat. Let's look at the next insurance, which is level benefit endowment insurance. For endowment insurance, expected value of z equals to the present value of the insurance for term and the actual present value of the insurance for pure endowment. So you are going to have AXN 1 plus AXN 1, which is equals to AXN. Expected value of z square equals to 2AXN, and the variance of z will be equals to 2AXN minusing AXN square. We're going to move to the next type of insurance, which is level benefit deferred whole life insurance. The difference between the deferred whole life insurance and whole life insurance is there is no payment during the deferral period for the deferred insurance. However, for whole life insurance, the coverage would be since the beginning of the policy up until the time that the person die. the policyholder dies. Okay, so expected value of z here will be equals to summations from the deferral period until infinity, b to the power of k plus 1 k given qx. Its actual notation is n deferred ax. Variance of z is 2 n deferred ax minus n deferred ax squared. The last one would be non-level benefit insurance. For the case of non-level benefit, it means that the benefit will be vary with times. We are going to look at the most common case, which is increasing of $1 every year. So if you look at this timeline, okay, this is time 0, the entrance of the policy, year 1, year 2, it will continue forever. If policyholder dies somewhere here, the amount of the benefit will be $1 and it will be paid here. Die somewhere here, the amount of the benefit will be $2. Let's have one more year here. Okay, die somewhere here, $3, and so on. Okay, discount factor would be v square, v cubed. Probability of receiving this would be qx. 1 given qx, 2 given qx, and so on. Expected value of this would be summations from k equals to 0 up until infinity, k plus 1 b to the power of k plus 1 k given qx. That's it for this video. Thank you.